Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
Yes, good morning. Welcome in for another edition of Retire Right with Rick Durkee. I am your host, Shane Griffin. Each and every Saturday morning here at 9 o'clock, I have the privilege of sitting down with our local retirement income planning and wealth distribution specialist with a capital S, Rick Durkee. Good morning, sir. How are you?
Good morning, Shane. I'm just sitting here listening, and you're saying, the intro is learn how to retire right. Certainly don't want the alternative.
No.
Retire wrong. So let's learn about some things of how to retire right today.
Absolutely. Before we get started, the topic today, by the way, is why investors should consider annuities. This is something that we've talked about multiple times over the course of the year. We don't typically talk much product. We do, as you like to say, put strategy first and then fit the product in with the strategy. But this article I found at wallstreetjournal.com kind of morphed both strategy and product, and I felt like it was something that we needed to discuss here this morning, if that's okay with you, sir.
Yeah, it's good, Shane. Oftentimes we got to go to the tool chest, pull out a tool that's going to work for the job, and annuities will create steady streams of income, a method of people taking those pension dollars or lump sum pension options,
right,
or perhaps some saved IRA money or 401k money, and creating income streams with that money. And that's what annuities can do. And there's a lot of different ways and different products to be used. So look forward to the opportunity to talk about them.
Before we jump to the topic, a couple of reminders. If you've missed a past program, want to go back and listen to a program, you can visit two places. First of all, Rick's website, cfpgroup.biz, cfpgroup.biz. All the shows are archived there. You can also visit our website, 943wsc.com, and search for the podcast page, and all the programs are listed there with their titles. So if you'd like to go back and listen to something that Rick was talking about previous, you can do that at cfpgroup.biz and 943wsc.com. Also, the transcripts are available. If you'd like to read the program, you can do that as well. They need to do that through the CFP group, correct?
They can. Call us at 735-5065 anytime you want a transcript for a show. We've got those all available by email copy.
Interesting time in the market, so let's go ahead and get started. Again, the topic this morning, why investors should consider annuities. David Blanchett wrote an article for the Wall Street Journal recently about why investors should consider annuities. He had, Rick, a couple of interesting points that I think we should cover this morning. So before we do that, let's break down the different types of annuities. I know they can be confusing, so many different options. Let's talk about the different type of annuities and how someone can use each different annuity to achieve their retirement goals.
Okay, Shane, different types of annuities. First of all, you have an immediate income annuity. That's the type where you give the insurance company a lump sum of money and you want to create that income stream from it right away. Now, most immediate income annuities are going to require what's called annuitization. Let me spend a minute and explain what annuitization means. It means that you give that lump sum to the insurance company, and then they guarantee you a payment for a period of time. Okay? Let's talk about a life-only period certain. Okay? This means that as long as you live, that payment will continue. Now, if you die early in that scenario, the insurance company gets to keep what's left in the pot, okay? Because what you're doing is you're actually helping those annuity contract holders that live a long time.
Right.
Because the insurance company is on the hook on a life-only settlement option, on an annuitization payout to pay the payment as long as you live. So if the pool of money is exhausted, the payment still continues to come to you.
Right.
Now, there's some ups and downs about single premium immediate annuities, or SPIAs, immediate income annuities. The ups are as guaranteed, okay? Guaranteed, offset longevity risk, no problems. The downside is that there's no payment increases in that payment. So inflation, if you live 20 or 30 years, could certainly ravage those dollars and not make them worth as much in the future as they are today. So a SPIA is often used to guarantee, maybe to fill an income gap. Maybe there was a pension that was already set up that was going to last 10 years, or a deferred compensation plan that was going to pay out 10 years, and then we got to fill that income gap with something else at the end of those 10 years, and a SPIA could work for that. So that's a single premium immediate annuity. Now, what most people, though, are using and have demanded from the insurance companies is, hey, I want to put the money in, but I don't want the income right away. I want to defer it for a while. I want to get that tax-deferred growth with non-qualified or non-IRA assets. I want to get that growth in my IRAs and then create a pension check from it sometime in the future. Now, you always have the option to use annuitization in a deferred annuity, which is what I just explained. It's one of the ways of getting income from an annuity. But secondly, you can choose withdrawal benefit options. Now, withdrawal benefit options, basic rule is you're withdrawing the money out. It is taxed last in, first out. So I didn't mention this about the single premium immediate annuity, but that is a portion of principal and a portion of gain that's paid out. So your tax liability is less in an annuitization as it is in a withdrawal. Withdrawal, it's last in, first out, LIFO method of accountability. So from a tax standpoint, all gains come out of that annuity that's been tax deferred first. If it's an IRA, it's fully taxable. If it's non-qualified assets, it's going to be all that interest earnings, bonus, anything that you get on the deferred annuity when you go in, between when you start it and when you pay out the payment. Now, so these withdrawal benefits now, what insurance companies have said, hey, people don't like it if you die early and the insurance company gets to keep what's left in the pot. If you're using a withdrawal structure, systematic withdrawal or a lifetime guaranteed withdrawal, the insurance company will give to your beneficiary what's left in the pot. Okay, and if you're using an income rider, which is really a guaranteed withdrawal benefit rider for income on the deferred annuity, then if you live a long time, you have longevity insurance because the insurance company will keep on paying that payment, even though your pool of money was exhausted that was funding that payment. And with many companies now have entered this marketplace of creating these withdrawal benefits, you need to look at the riders. You need to have them explain to you what are the costs, what is involved with this. Oftentimes, riders will add additional costs that may not be beneficial for you if that's not what you want or need this annuity product to do for you. So definitely take a look at the insides and how that withdrawal payment is going to be paid out. The other thing you need to look at when it comes to withdrawal benefits is that, Shane, you want to make sure that withdrawal benefit, if it's a lifetime income benefit, is not locked in like that SPIA payment was, that single premium immediate annuity. If that's the case, then you're not going to be able to offset inflation. Some of the newer products have increasing payment options on the withdrawal benefits, and that's certainly a good hedge against inflation risk. So there's your withdrawals and ways that you can take monies out of annuities. A deferred annuity, you could just keep it deferring and deferring until you die, and then your beneficiary would receive it, and they'd have to pay taxes on the gain at that time. There's 3 types of deferred annuities. Very quickly, fixed annuity works like a CD at the bank, guaranteed interest rate, typically locked in 1, 3, 5, 10 years, okay, and you get that locked in guaranteed interest rate. Then you have a variable annuity, which has the ups and downs of the markets. Its accumulation value is subject to risk. However, if a rider is added to it, and this is where a lot of people make mistakes in understanding the variable annuity, if a rider is added to it for income or death benefit, which there is a cost involved, then that rider will guarantee a certain percentage gain every year in that variable annuity, no matter what the account value does or the markets do. So here's the only downside of the variable annuity. You want to get out and say it's after your surrender charge period, which may last 4, 7, maybe as long as 10 years. You want to get out, and it's after your surrender charge period and the market's down. You're not going to get the income benefit. You got to take that in a payment. You're going to get the accumulation value. Market's down. You've got a surrender charge now that is market value adjustment. It's, there's been a downturn in the market. So variable annuity is sometimes not quite applicable for retirees.
And we've talked about that product before on the program.
We have. Now,
good for some, bad for others.
Well, just depends on your situation. Again, it's a tool. We're going to pull it out, and a variable annuity may be very appropriate for someone that just wants to defer income for perhaps a beneficiary, okay, that can get the market, ups and downs over a long period of time in between now and when you die, and it's going to go to the beneficiary anyway. So third type of deferred annuity is the fixed indexed annuity. It is a blend between your fixed annuity, which provides a guaranteed minimum interest rate, and then also it can participate in market gains. But the key word there, folks, is participate. You don't get all the ups when things are going up. You get none of the downs when things are going down. And some of these fixed indexed annuities now have income riders that have been added to them, some without a fee, some internal fee, some, with a fee, a lot of different options, many different variations. So here's the key. I'm talking to you right now. You've got an annuity of some sort and you don't know what type it is. Okay. You remember a few things and you say, wow, he just told me about 5 things that I think I remember I've got in my annuity. You need a variable annuity MRI. You need to put that thing under the magnetic resonance imaging system, and you need to get all the details to that. And folks, it's easy to get if you know what questions to ask. But 9 times out of 10, when people come in to visit us for a 3-step review, they don't know what questions to ask, and they don't know how that annuity operates. I'm not saying that you should replace those variable annuities or fixed indexed annuities or fixed annuities. What I'm saying is you need to understand how it works. And if it is in your best interest to keep that product, then, folks, I will tell you this, that there's no insurance company out there that's going to replace your annuity knowing that you are it's not in your best interest to do so. Okay, they have replacement rules and guidelines. So go through an annuity MRI.
Well, what
come
is
in
that?
And visit
Walk us through that.
Come in and visit us at the Coastal Financial Planning Group. I'll tell you how it works. I'll give you an example. Had a client that actually a prospective client, not a client yet, but was going through our 3-step review and had several annuities that had been set up about 10 years ago. And they thought they understood how they worked. So I said, you know what, bring in your most recent statement. I'll write down what I can off of that annual statement, and then I've got a checklist here, and we'll call the insurance company, and we'll get one of their representatives on the line, and I'll tell you, folks, most of the time they've got a computer screen right there, and they're answering the questions, but they are giving accurate information, and I'll just go down that checklist, and I will analyze that annuity and see if it's in your best interest to use it per your direction as to how you want to use that money in the future. If it's got a great income rider on it and it's rolled up, it's 6 or 5%. Some of the older variable annuities have that on there, and it pays out the way you want to and creates the money that you want to, then heck, let's just burn that into your income plan. Have it, it's there, it's a guarantee, and let's just place that as part of your pension check for retirement. If you don't have any annuities now, today, you may want to go through a 3-step review just to see if you want to pensionize part of your retirement assets to make an income stream for a period of time, or perhaps your lifetime, or perhaps you and your spouse's lifetime. Many options to do that. I know I've rambled on this one, but Shane, we've covered this topic many, many times, and always want to get people to act on this information. Call us today, 735-5065. You've got an annuity. Pull out your statement. Call me. I'll talk to you about it today over the phone and give you some basic knowledge. But I'm going to encourage you to come in and do a full review of everything and what your plans are so that we can sit down and give you some recommendations as to what you should do with products that you've purchased in the past and what you might use in the future.
Well, and we've talked about this before. Using annuities are good for just a portion of someone's retirement portfolio, not something that I have a pile of money, let's put it all in an annuity. It's good for just a portion, correct?
Yes, Shane, as we've talked about before, as we move away from these defined benefit plans to defined contribution plans, we have to figure out a way to pensionize or create that income stream with our money so we can ensure that we'll have enough money for life. Unfortunately, few people in the U.S. annuitize a majority of their assets. However, I've have situations where I've had clients annuitize a major portion of their assets because they still knew that they had the equity in their homes if they needed to tap into that for additional needs, but they just wanted to create a pension guarantee for them and their wives. So depends on the individual situation. I would also say that it is always often a smart decision to use a portion of your assets with guaranteed income and then take the rest of them and put them at risk. But measure that risk as to how much risk you want to take and what that money may be used for in the future. Make sure it's going to be there when you need it.
Yeah,
okay, manage downside risk.
Absolutely. Well, Rick, I think we've laid a very good groundwork this morning on the basics of annuities and how best to use them. For a person listening this morning, are there certain factors to consider when looking at annuities?
Well, certainly, if you like the idea of a guarantee and you're someone that seeks certainty, then you should use the insurance company's guarantees that are used through annuity products. If you're in good health and have a family history of longevity, certainly an annuity would be a no-brainer. You want to make sure that that money lasts as long as you do. The longer you live, the more the annuity is going to pay off.
Right.
You're part of the mortality statistics. You're one of the winners.
You're in a spreadsheet.
Yep. Certainly if you don't have much existing guaranteed income, maybe all you have is Social Security and you have some 401k assets or whatever that you want to create a pension check with, then an annuity would be appropriate in that situation too. The key to the whole thing is make sure you understand your income needs and expenses in retirement, and then project out what that annuity could pay out for you. Make sure that that's adequate. If it's not, then you may have to find some other sources to help fund retirement also. And it may be that you're not a good annuity contract candidate because you don't have the liquidity that insurance companies now require also. They want to make sure that you're not putting all of your eggs into one basket, because if you have to come out early out of that annuity and it's in a deferral stage and it's in its surrender charge period, you could pay surrender charges.
So the insurance company
out.
actually will manage that on the back end as far as making sure that someone is not putting all their eggs in one basket per se.
They will on the underwriting. They will not accept dollars if the potential candidate has lack of liquidity. Yep.
For additional information on the topics we are discussing this morning, 843-735-5065, the number to call. If you have an annuity and you would like to have an MRI done of that annuity, you can call this morning, 843-735-5065, and go through an annuity MRI. Also, too, if you'd like to set up the exclusive 3-step review, 843-735-5065, the number to call. If you'd like more information on Rick and his team at the Coastal Financial Planning Group, the website is there, cfpgroup.biz, cfpgroup.biz. Before we get to our last question, a reminder to our listener this morning, Rick, you've got some Social Security workshops coming up here at the end of June, and wanted to finish up the article, but first, let's pause for a moment and jump into that. The workshops, those are critically important for folks to get more information about how to properly time benefits in Social Security, correct?
Shane, this is a great way to segue into the end of the show here. We do have those Social Security planning workshops coming up, and one of the best ways to annuitize your wealth today is by delaying claiming your Social Security benefits. Social Security is actually an annuitization payout based on the work credits that you put into the system, and it's it has survivor benefits, meaning that if you die, your wife or your spouse, husband or wife, spouse will continue the better or greater of the two benefits throughout the remainder of their life. So it is a life settlement annuity payment with survivor benefits. It's not really possible to get higher payouts from an annuity that you'd buy from a private insurance company when compared to delaying Social Security benefits. So there's this added benefit of things like favorable taxation on Social Security benefits that we'll talk about in our workshop, and then also higher potential spousal survivor benefits depending on how you claim benefits. What the new rules are, there were some recent rules that changed in Social Security. You definitely want to be aware of those.
Right.
And certainly if you're in that 60 to 65 range and you have not opted to take your Social Security benefits, this particular workshop, which I think you've got the dates for.
Yeah, June 23rd, 24th, and 27th.
Yeah. Visit the website, cfpgroup.biz. Call us today, 735-5065. It is going to be a workshop with dinner provided. It's on a Thursday night, Friday night, and Monday night. So choose one that fits best for you. If you and your spouse are saying, hey, Friday night's date night, well, come out and have dinner with us and learn a little bit about Social Security.
There you go.
And if you're working on Friday, Saturday, and Sunday, then Monday night might be your date night. Whatever it is, certainly visit the website. You'll find out more about Social Security. And just a reminder to our folks listening today, annuities are paid out to us already. They're paid out to us in Social Security benefits.
Yep.
They're paid out to us in your pension checks. Why not look at how much income do I have coming to me now? Is it enough? How much do I need to fill the gap? Look at an annuity product to fill that gap with an income stream that could be guaranteed for your life if that's the way you want it.
What would you say the percentage of folks that come see you that have an annuity have no idea what type of annuity it is and or have not even looked at it in a long time?
Well, that's that need for the annuity MRI.
Yeah.
Yep. We need to look at that annuity
do you find
and see
that
if
common?
it still
Folks
fits.
walk in and go, look, I have no idea what this is, nor can I remember, nor can I understand the language in which it's written.
I would say it's common, but I would say more common is the person that thinks they know how it works, but then once we do that annuity MRI and we're on the air live with the insurance company on a phone on a 1-800 number and we're asking questions, I see people's light bulbs just going off. It's like, whoa, I remember that, but I don't remember that. And
because life changes in 10 years, your needs change over that course of a decade.
Yeah, and really, I'll tell you where it was really about 2008, 2009, where a lot of variable annuities were sold. And I'll tell you where they were sold. When that investor went back to their broker and said, look, we just lost 50% of my assets. I don't want to do this again. So I want some type of a guaranteed program in between now and when I start taking income out of this, that this thing's going to defer and grow without loss. And so variable annuities were sold in the investment world. Okay. Now, again, folks, everybody's financial plan and need for how they want and need their money to work throughout their retirement years is different. And it changes, as you just mentioned, Shane. So an annuity MRI is going to help teach you how that annuity works, how it's set up, how it defers, how it pays out, and you need to have that information because it needs to integrate into your retirement income plan. And if it doesn't fit anymore, well, if the glove doesn't fit,
you must have quit.
That's right. Okay. So anyway, that seems to be a topic that's back on the TV here lately. So
it's
anyway,
funny, you hear that sentence and you naturally finish it with that.
I know. And, but if you think it's butter, but it's not, what is it? It's chiffon, right? Okay. So I don't think they even make chiffon anymore. But,
not sure.
But anyway, those are those old adages that just come to mind. You're looking at Here's another one. I'll just say annuities are
bad.
Yeah, most people would say annuities are bad. Why are they bad? It depends on the situation.
Right.
Maybe it wasn't sold properly. Maybe the particular individual was not acting in a fiduciary capacity when they recommended those annuities to people and didn't really care how they would act in the future. We typically replace those nowadays when people come in to visit us for a 3-step review. There's plenty of options, folks, and actually with the markets doing what they've done since 2008, a lot of those account values in the variable annuities are up there real close to what the income guarantees are on the actual guaranteed roll-ups. So you can look at that it is not a bad decision to not use the income guarantee portion of that variable annuity and replace it with something that may be more appropriate for you now as you are in retirement or perhaps nearing retirement's doorstep.
Solid topic this morning. Again, the article from WSJ.com, WallStreetJournal.com. The topic, why investors should consider annuities, and that's an article from David Blanchett. If you'd like a copy of that article, you can send Rick an email, rick@cfpgroup.biz, rick@cfpgroup.biz. A reminder about the podcasts at cfpgroup.biz and 943wsc.com. A reminder about the upcoming workshops, June 23rd, 24th, and 27th. All the information on these workshops can be found at the website, cfpgroup.biz. Rick, great to see you. Back here next Saturday at 9 o'clock.
Shane, final question to our listeners today. Have you purchased or avoided annuities perhaps based on misinformation or misconceptions? Would you agree that you should know all of the information before making a financial decision? Would you like to learn more about reducing your risk and shifting the odds in your favor by linking your long-term benefit to a market index? Those are questions that you want the answers to before you make a decision about any type of annuity. Join us again next Saturday morning here on 94.3 WSC FM and 94.3WSC.com for another half hour of Retire Right with Rick Durkee.